Welcome to this comprehensive explainer on the Finance Act 2024 inheritance tax rules. Think of this as your personal masterclass. Since you're gearing up for exams, I'm going to take things at a very deliberate, measured pace. I want you to really absorb every single detail, every threshold, and every condition we cover today. So, grab your notes, get comfortable, and let's break down this complex framework step by step. Let's dive right in. Here is our syllabus for today's session. We'll be covering framework and thresholds, exemptions and lifetime transfers, the death estate and valuation, vital reliefs and anti-avoidance, trusts and post-death planning, and finally, exam strategy, CGT versus IHT.
Section 1. Framework and thresholds.
Okay, this table right here, it is the absolute bedrock of all your tax calculations for the 2024/25 tax year. You need to memorize these numbers. The nil rate band, or NRB, is £325,000. The residence nil rate band, the RNRB, is £175,000. Now, both of those are frozen until at least 2028/29. The standard IHT rate on death is 40%. For chargeable lifetime transfers, it's exactly half that, 20%. And remember, if a client leaves at least 10% of their estate to charity, that death rate actually drops to 36% on the non-charitable part of the estate.
Which brings us to a really critical benchmark you are going to see a lot in your exams: £1 million. This is the maximum combined threshold achievable for a married couple or civil partners. How do we get there? Well, if the first spouse to die doesn't use their £325,000 NRB and £175,000 RNRB, that unused proportion transfers directly to the survivor. So on the second death, the survivor has their own $500,000 allowance plus the transferred $500,000. Boom, a cool £1 million entirely shielded from IHT.
Section 2. Exemptions and lifetime transfers. Now pay very close attention to these permanent exemptions. Transfers between UK domiciled spouses are absolutely unlimited. But watch out. If the recipient spouse is non-UK domiciled, that exemption is strictly capped at £325,000. Next up, every donor gets a $3,000 annual exemption. You can carry forward any unused amount, but only for exactly 1 year, and you have to use the prior year's allowance before touching the current year's. Then we have the $250 small gifts exemption. Listen closely here because this is a major exam trap. You absolutely cannot combine the $3,000 annual exemption and the $250 small gifts exemption for the same recipient in the same year. Just don't fall for it. Let's look at a remarkably powerful tool. This exemption is highly testable, mainly because it has absolutely no monetary limit. To qualify as normal expenditure out of income, you have to strictly meet 3 sequential conditions. First, the gifts must form a normal, regular pattern. Second, they have to be made purely out of income, not capital. And third, crucially, making the gift must leave the donor with sufficient income to maintain their usual standard of living. You need to make a crystal clear distinction here between pets and CLTs. A pet, or potentially exempt transfer, is a direct gift to an individual. It triggers 0 tax when it's made, and it falls out of the tax net entirely if the donor survives 7 years. A CLT, a chargeable lifetime transfer, is different. This is a gift into most types of trusts, and it triggers an immediate 20% tax charge if it exceeds the nil rate band. Now, both of these utilize the 7-year accumulation clock. That means if the donor dies within 7 years, both are pulled right back into the estate and reassessed at the 40% death rate. Section 3. The death estate and valuation. So when a client passes away, the estate includes all assets owned at the date of death. Notice that property held as joint tenants passes automatically outside the will, but 50% of its value is still included in the estate for IHT purposes. We value these assets using the diminution in value principle. Think of it essentially as the drop in the donor's overall wealth. From that total, we deduct reasonable debts and funeral expenses. For shares, remember your quoted quarter-up rule, and be very wary of unquoted shares. They might trigger related property rules designed to prevent artificial fragmentation of value. You need to be incredibly careful when you see estates exceeding this next number, £2 million. If an estate crosses this threshold, the $175,000 residence nil rate band begins to taper away. The rule here is strict. You lose $1 of RNRB for every $2 the estate exceeds $2 million. So by the time an estate hits $2,350,000, that RNRB is completely wiped out. Now, what happens if our donor makes a substantial gift but dies before making it to that 7-year finish line? Well, we apply this tapered relief timeline.
For the first 3 years, 100% of the calculated death tax is due. But if they survive between 3 and 7 years, the percentage of tax payable steadily drops. It goes down to 80%, then 60%, then 40%, and finally just 20% in year 6. Please write this golden rule down right now. It is the single most common error students make. Taper relief reduces the calculated tax, not the original value of the gift. I'll say that again. It reduces the tax, not the value. Furthermore, it only applies if the death tax calculated actually exceeds the lifetime tax already paid. If a CLT was entirely covered by the nil rate band, paid no lifetime tax, and still falls within the NRB at death, taper relief is completely irrelevant.
Section 4. Vital Reliefs and Anti-Avoidance. Business Property Relief, or BPR, is arguably the single most powerful tool in inheritance tax planning. A sole trader business, a partnership interest, or unquoted trading shares can attract 100% relief. That means zero IHT. Quoted shares where the donor has voting control or land used in the business attract 50% relief, but there are strict conditions here. You need a minimum 2-year ownership period, and the relief completely fails if the company is primarily an investment holding company rather than an actual trading entity.
Next up, we must discuss the Gift with Reservation of Benefit, or GWR. Imagine a parent gives their house to their child, but continues to live there rent-free. That right there is a GWR. The law pulls that asset right back into their death estate. The only way to cure this is if the donor pays full market rent. Now, this operates alongside the Pre-Owned Assets Tax Charge, or POATC. The POATC hits donors with an income tax charge if they try a clever workaround, like giving cash to a child to buy a property that the parent then lives in. HMRC is always watching.
Section 5. Trusts and Post-Death Planning.
Since March 2006, virtually all transfers into trusts are treated as chargeable lifetime transfers. If a client uses a discretionary trust, not only do they face that potential 20% entry charge, but the trust itself faces a periodic charge of up to 6% every 10 years. On top of that, there are exit charges when assets actually leave the trust. Yes, they are complex, but they are highly controllable vehicles for long-term wealth management because they keep assets outside the beneficiary's direct estate.
Now, what if a will just isn't tax efficient? A valid deed of variation allows beneficiaries to flexibly redirect their inheritance. But to be valid, it has to meet these exact non-negotiable conditions. It must be in writing. It must be executed within exactly 2 years of death. It must be signed by anyone who is losing their entitlement, and HMRC must be notified. If done correctly, it is legally backdated to the original date of death. This is absolutely perfect for skipping a generation to save future IHT or redirecting 10% to charity to secure that lower 36% tax rate we talked about.
Section 6. Exam Strategy, CGT versus IHT.
This right here is a classic exam scenario. If a client holds an asset until death, capital gains tax is completely wiped out. The base cost simply resets to market value. However, the asset is hit with that heavy 40% IHT. Conversely, lifetime giving freezes the asset's value for IHT purposes and starts that 7-year clock toward total exemption. But the massive trade-off? Gifting an asset during your lifetime counts as a disposal at market value. That can potentially trigger an immediate capital gains tax liability.
So your ultimate exam takeaway is to analyze the full portfolio asset by asset. If a client has BPR qualifying shares, they're already exempt from IHT on death, so hold them until death. That way you avoid CGT entirely. On the other hand, if a client has cash or government gilts, which are exempt from CGT, they should aggressively gift those during their lifetime. That shrinks their taxable estate without triggering any capital gains charges whatsoever. I'm going to leave you with this final thought to really challenge your understanding. When you sit down for your exam, don't just look at the numbers in isolation. Apply this highly structured chronological framework. Look at the exemptions, really understand that 7-year clock, and balance the CGT against the IHT. How will you logically dismantle your next complex exam scenario to achieve absolute tax efficiency for your client? Thank you for joining me for this explainer. Keep studying hard, take it step by step, and you've absolutely got this.